We're looking at 6 undervalued dividend stocks that investors are buying. As always, we're going to take a look at the historical performance of these companies. We're going to look at their dividend safety, jumping into their financial metrics. And as always, we will run them through our valuation model, getting to our intrinsic value and what we believe to be our acceptable buy price given our investor margin of safety, and also see what Wall Street are forecasting for these prices over the next 12 months. Jumping into the first undervalued dividend stock, we have BTI, British American Tobacco. Now, over the last year, it is down around 24%. We can see it trading pretty much at its 52-week lows with a forward PE of 6.3 and a dividend yield now nearly touching 10%. If you've been holding this company over the last years, bearing in mind it doesn't include those dividends reinvested, you would be down around 42% purely on share price return. So let's take a look, and we can see it did hit its all-time highs in around 2017, quite some time ago at $72. Dividend safety score 45, borderline safe. We'll touch upon that shortly. Market cap 65 billion, a large cap company. Now, in terms of those recessionary metrics, for those that see a recession inbound, well, they increased the dividend during the 07-09 crash. They had plus 5% sales, above average growth. Remember, 07-09, that was around negative 12% on average, and they did beat the S&P with a negative 31% recession return versus the S&P's negative 55. Now, dividend growth, last full year 1%, not the greatest. Last 5 years 4% on average year on year. Last 20 years 10%, so pretty solid, double digits over the longer term. But do bear in mind these are paid out in British pounds, so you will have some FX rates, so there will be some slightly different rates for non-UK residents. Dividend growth streak, well, they have been increasing those dividends for the last 23 years, so they are 2 years away from becoming a dividend aristocrat. In terms of dividend yield theory, it should come as no surprise. We have a double sign of undervaluation. The first sign, which is dividend yield theory, shows that a company is undervalued when the current yield sits above the 5-year average, 9.49 versus 7.46. But remember, we don't look at any of these models in isolation, and we will draw conclusions towards the end. Forward PE 6.1 versus that 5-year average of 8.6. Sector P comparison, while consumer staples does sit at 19.5, with BTI significantly lower. In terms of the payout ratio, for regular viewers, you know we do ignore earnings. It is susceptible to manipulation by management through accounting. We focus on that free cash flow payout, and what we like to see is below 85% for tobacco companies. Now, over the last 6 years, very, very positive. In fact, below 60%. 2023 at 51% is a very good sign for them to continue to pay that very high, nearly 10% dividend yield. Free cash flow per share, well, 195 in 2013, 432 in 2022. It has been increasing, in fact, more than double. But one thing to note is the inconsistencies. You do go through periods such as 2013 to 2017 where there is relatively little movement, and you see that again 2018 to 2022. So always good to understand the type of companies, the industries that you're investing in, and what to expect moving forwards. Sales growth, well, it does look very cyclical, but what we do see a period from 2013 to 2015 with little to negative growth, and then we see 2016 to 19 with some strong double-digit growth, followed by flat sales for 2020-2021. But in more positive news, the last 2 years, 8% in 2022 to the top line. Last 12 months, so 2023 is expected to be 7% when that annual report comes out. So it is positive news, especially when you compare it to others in this industry, the tobacco industry, where like Altria, whose top line does fall. Now, in terms of numerical, we can see 15 billion in 2013, just under 30 billion expected in 2023, so around double in terms of that top line growth. One thing to note, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to investors. What we can see here is the opposite. They have diluted your position. From 2013, it has gone from 1.91 billion shares outstanding to 2.25 in 2023, something just to consider. And then we jump into the ROIC, return on invested capital. Now, one thing to note, I do like to see 10% or more. The reason for this, it gives me faith that management are able to effectively allocate their capital. What we can see, it has been pretty low over the last 6 years, but we can see in 2023 it is expected to be 10%. So that does give me faith. It is something I am happy about if I was to be an investor. But one thing to note with Ultra, they do have a much higher return on invested capital. In terms of operating margin, free cash flow margin, well, we can see very good news on both. The operating margins are very high, which is something that is common in the industry. 48%, very, very strong. In fact, the highest it has been over the last 10 years. Free cash flow margin, in fact, very consistent over the last 4 years at 35%, well above that minimum 20 we look for tobacco companies. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. New viewers, this essentially shows us two things, the dividend safety as well as the balance sheet strength. With this being the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, it's 2.96, which is just below that 3 maximum. 2023 expected to go even lower. So that is a positive sign. Whilst the balance sheet isn't the strongest, it still looks fairly healthy. And that dividend, as we saw with that low free cash flow payout, does seem to be relatively safe based on the information we have. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash the like button and hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through every single one of these models in our deep dives. For today's episode, where we're running through these 6 companies, we'll jump straight into the intrinsic value calculator. And this gives an intrinsic value in today's episode for BTI of just under $53. Now, how do we work with the margin of safety? If we believe 3 criteria for any company, a wide moat, strong financial metrics, and good forward-looking data, we use 10%. Now, for the company in the tobacco industry, with a lot of people do believe it is a dying industry, although some bullish people do also see that there is a lot of room for growth in countries such as India, where this is a growing market, as well as the tobacco. When we put that to one side and we look at the marijuana and other stuff like that, it is looking like a very positive new market for these companies. So if we increase that margin of safety, we can see at 20% it is still an acceptable buy, at 30% still a buy, at 40% pretty much not far off the current trading price. So we see for British American Tobacco around a 40% margin of safety. In terms of Wall Street and what they forecast, well, they see a price target of $47 over the next 12 months. So they see some significant upside of over 58%. But as we always say on the channel, always do your own due diligence. Never rely on what Wall Street say, but you can use it as one part of an investment thesis. Now, before we jump onto the second stock, just to let you know that we do have a free weekly newsletter with the latest article just being sent out today. We do run through in today's newsletter the 7 golden dividend metrics. If you do want to have access to it, it is completely free. Just click on the pinned comment below and you will receive free newsletters every week on different topics. Today's being how we analyze different stocks. So let's jump into the next company. We have Canadian Pacific, and we can see over the last year it is fairly flat, up only really 1%. Over the last 10 years for this company, however, they are up around 177%, currently sitting at the midpoint of the 52-week range with a yield of just under 1% and a forward PE of 28. In terms of dividend safety score, where it sits at 76 safe, market cap 73 billion, a large cap company. In terms of recessionary metrics, well, they maintained the dividend during the last recession. They had average growth, as we said, around negative 12%, but they also trailed the S&P with a negative 64% return versus the S&P's negative 55%. Now, they haven't increased that dividend since 2020, but on average, if you have been holding it over the last 5 years, your dividend would have increased 12% year on year and 11% year on year if you've been holding over the last 20-year period. So there we go, 0 years of consecutive increases, but they have been paying dividends for the last 20 years without a reduction. Dividend yield theory, then we can see this would be a sign of overvaluation as the current yield is below the 5-year average, 0.7 versus 0.84. Forward PE, 24.8, higher than the 5-year average of 22.3. And if you wanted to compare Canadian Pacific to the industrials sector PE, it is sitting lower with industrials at 20 and CP at 24.8. Jumping into the free cash flow payout, well, they haven't increased that dividend for a few years, and we can see 2023 payout ratio at 32% isn't that bad, and I would like to see them start to increase that dividend, if not at least keeping up in line with inflation. Free cash flow per share, well, it's gone from 82 cents in 2013 to 278. It is increasing, although inconsistently, and something to point out is 2023, they're expecting that free cash flow per share to drop from the prior year. Sales growth then, we can see 3 to 7% is our target for steady moderate growth. 2022 very positive at 10%, 2023 very strong 34%. So their top line has been increasing quite strongly over the more recent period, and it has gone from around 6 billion in 2013 to just under 12 billion in 2023. So in terms of shares outstanding, now up to 2021, they were doing share buybacks, returning excess cash to investor pockets, but they did do an acquisition, and therefore we can see that share outstanding rise to 933. If you do want to hear more about that acquisition, do click on our Canadian Pacific tutorial or video where we do run through this company in a deep dive session. ROIC then, remember 10% or more. We can see up to 2020, again, it was around 17 to 18%. It did dip again, some part due to the acquisition, and it is currently expected to sit at 6% in 2023. In terms of the free cash flow margin and operating margin, very strong. It is fairly inconsistent. It hasn't been consistently one number, or it hasn't been leveling. We can see it go from 30% though to 40% expected in 2023, which is still positive over the longer run. And the same can be said for the free cash flow margin. 12% in 2013, 20% expected in 2023. In terms of the net debt to EBITDA, it is a little bit too high for comfort, but again, do bear in mind that acquisition, which would have affected some of these metrics. 4.24 expected in 2023. The more positive to note is in 2024, they are expecting to bring this down a lot closer to that maximum we look for at 3. So let's jump into the valuation of Canadian Pacific, and don't forget you can click on the pinned comment below if you want to grab a copy of this intrinsic value calculator to get to the acceptable buy price and intrinsic value of companies in your own portfolio and those on your watch list. So a margin of safety at 10%, we can see it is pretty much trading at that level of 10% right now at the current value of $78.51. And Wall Street, they expect this price to hit around $90 over the next 12-month period, seeing around 15% upside. As we do run through these stocks today, do let us know in the comments below whether or not you as well have been adding some of these stocks, or if you are waiting for certain price targets before entering. Moving on to the next stock, we have Deere and Company. Now, over the last year, they are down around 6%. They're trading towards the mid to lower end of the 52-week range with a yield of 1.54% and a forward PE of 13.5. Over the last 10 years, though, some very nice share return performance, up 344%. Dividend safety also looking very safe, a score of 83 and market cap just over 100 billion. In terms of recessionary metrics, well, they maintain the dividend below average growth and also trailed the S&P. Dividend growth, however, a very nice story. Double digits last full year, 16%. They did increase, in fact, the dividend more than once. Last 5 years, 14% on average. Last 20 years, 13%. So this is a very strong contender to be a very big dividend growth company in your portfolio. And they have been increasing the dividends for the last 3 years. As we know, in 2019, they did keep that dividend flat. Moving on then to the dividend yield theory, we have that sign of undervaluation, 1.54 versus 1.3. Also the forward PE, 13.6 versus 15.6. And when we take a look at the sector PE, Deere is still significantly lower than industrials at 20. Let's look at the free cash flow payout. Now, 2022, and this is one reason why we always say free cash flow over earnings. In 2022, you'd see 18% on the earnings. You would be happy. 2022 on the free cash flow, you would realize that the company paid out more in dividends in 2022 than they generated in free cash flow. In more positive news, 2023, they did bring this down to 36%. 2024 expected to go even lower to 27%. So there is some good news, but something just to consider as the years do progress with this company. Free cash flow per share, very inconsistent. 2014 to 16, flat. 2017 to 19, negative. And then 2020, 2021, very strong numbers. And then it did decrease before rebounding. Something to know, this is a fairly cyclical industry. So remember, with these type of companies and industries, you do want to be buying them when they are out of favor and then riding them into when they become very popular. Sales growth then, it does just show us that cyclical nature. Negative growth a few years, followed by positive growth, followed by negative growth, and so on. But in better news, the last 3 years have seen some strong double-digit numbers to the top line. and numerically speaking, it has gone from 36 billion to 61 billion. In terms of shares outstanding, well, we can see some share buybacks, some share issuances, but overall a very positive case here with 366 million shares outstanding dropping to 294. So they have bought back nearly 20% of those shares outstanding from 2014. ROIC, again, fairly inconsistent, but in positive news, the last 3 years have been strong double digits over that 10% that we aim for. Operating margin, again, inconsistency does seem to be the nature here, but again, cyclicality is something to remember. 2023, 25%, very solid. Again, the same can be said for that free cash flow margin. Net debt to EBITDA, this is very positive in my opinion. It's sitting around 1 in 2023, well below the 2.5 for heavy equipment makers. And what we can see and understand now why that dividend does look to be very safe, and their balance sheet is looking fairly healthy. So in terms of the valuation, as always, it is just the average of the models that we've used. And for today's episode, it's coming to $456. Margin of safety of 10%, then we have a buy up to $410. At 15% up to $387. And we can see it isn't quite there yet at a 20% margin of safety. So we believe for Deere and Company a 15% margin based on the estimates and judgments. In terms of Wall Street's price forecast, well, they see around $445 over the next 12 months. With upside of 16%. Next up, we have Kroger. Now, Kroger is up around 4.5% over the last year. Over the last 10 years, up 155%. Bearing in mind, though, they did hit their all-time highs in April 2022 of around $62. They're trading in the mid to lower end of the 52-week range, a yield of 2.5%, and a forward PE pretty much at 10. Dividend safety score 71, it is safe. Market cap 33 billion, large cap company. In terms of those recessionary metrics, well, increase the dividend, above average growth, and also outperform the S&P, negative 31%. Dividend growth, lots to love here, similar to Deere and Company. Double-digit increase last summer, double-digit increases year on year over the last 5 years on average, and the same can be said over the last 10 years. In terms of dividend growth, well, they have been increasing those dividends for the last 16 years. Dividend yield theory, we have that double sign of undervaluation, 2.53 versus 2.18. Forward PE, 10.4 versus 12.1. And we can see the consumer staples sector PE is much higher at 19.5. In terms of free cash flow payout, well, 50% in 2023, but we do know historically for the majority of the last 10 years, it is fairly low. 2024 expected to come down to 31%. Free cash flow per share, more inconsistency here, although again, it has increased 121 to 198. 2024 expected to go up to 375. So yes, it does increase over the period, but bear in mind there are some years of negative growth as well as many years of staying flat. Sales growth 3 to 7%. Now it has hit that target over the last 3 years, but again it does go through periods of fairly flat revenue, something just to consider. There is a fair amount of inconsistencies, and we do see it increase from around 98 billion in 2014 to 148 in their latest annual report. Shares outstanding though, I do like to see this consistent share buybacks, and quite significantly here as well. 1.04 billion in 2014, 727 million in 2023. Lots to love here, around 30% buyback of those shares. ROIC, again, very positive, pretty consistently above 10%. Yes, it does fluctuate 10, 17, 15%, but over the longer term, it is staying above that 10% target. So that is very positive when I am considering management with this company. Now, this is the area that I would say I would flag as a red flag indicator, just something to consider. Their operating margins are squeezed a lot. It isn't uncommon for it to be at 2%. Just bear in mind, if the consumers do start to get squeezed with an impending recession, if it happens, then they may try to lower their margins to entice more customers, and this will really put pressure on their bottom line. And we can see the same thing being said here on the free cash flow margin. So just something to consider. It is just a essential bearish scenario, but as always, we need to have a thorough investment thesis before investing. 2023, 2.22, pretty strong. It is below 3. 2024 expected to be a little bit lower. So again, the dividend does remain to be safe. Balance sheet does look fairly healthy. In terms of the valuation then for Kroger Company, we can see in today's episode that the intrinsic value is coming to $50. Now, margin of safety, when we start off at 10%, it is pretty much a few cents shy, so we do expect a 10% margin of safety for Kroger. In terms of Wall Street, they have a price target of around $51, so upside of 11%. So in conclusion, 10% margin of safety, 11% upside. Again, let us know your thoughts in the comments below whether or not any of these are attractive to you as an investor. We then move on to UGI Corporation. Now, this has a fairly nice yield of 6.8%, although it has been absolutely obliterated, down 43% over the last year. It is pretty much trading at its 52-week lows with a forward P of 7.85. Over the last 10 years, you can see you would be down 20%, and we see its all-time highs at around 2018 of around $60. So let's take a look. The dividend is 60, borderline safe. Market cap 4.66 billion, a mid-cap company. In terms of those recessionary metrics, well, they increased the dividend, they had average growth, and they significantly outperformed the S&P, negative 16% to the S&P's negative 55. And this is something I really like to see. You are starting a very strong forward yield. The increase last year means you are keeping up with inflation, as we always advocate 4% or more on the channel. Last 5 years, 8%. Last 20 years, 7%. That is very positive for a company that is paying a very strong yield. And even more, from my opinion, to love about this company, they are a dividend aristocrat. They've increased those dividends for the last 25 years or more, and they have been paying dividends without a reduction for the last 139 years. Take my hat off to that. That is very, very impressive. Dividend yield theory, again, double sign of undervaluation, 6.79 versus 3.61. 5-year average, 7.9 versus 13. So again, we can see undervaluation based on these signals. And we do see the utilities sector P is much, much higher at 15.5. Taking a look at the free cash flow payout, unfortunately for utilities, we can't use this because it is a lot more volatile. So we do focus on the earnings, and it has been below that maximum that we set for this industry at 75%, 52 in 2023. Well, earnings per share then, $1.99 in 2014. It does increase over the period, but again, it isn't consistent. There are some years where it does remain flat, some years, as we can see here, where it does drop. So again, bear that in mind. It is fairly common in the utilities industry. And we can see the cyclicality nature, years of double-digit growth followed by years of double-digit negative growth. And we can see their latest year, negative 12% to the top line. And numerically speaking, it's gone from around 8 billion to 9 billion. Shares outstanding, again, very common in the utilities industry, where they do essentially issue equity and dilute your position to fund a portion of their growth expenditures. It's gone from 175 million to 210. ROIC, well, up to 2022, it actually wasn't that bad, as we can see here. But unfortunately, in 2023, it has gone into negative, and it is something that we have discussed in the latest UGI deep dive. Operating margin then, it does straddle around the 18%, not as consistently as we would like. So again, something just to bear in mind with this company. There's nothing wrong with this company per se, but you need to understand the type of company you're investing, some of the positives, some of the negatives, and things to look out for. Net debt to EBITDA, well, 2023, 4.17. It is below that 5.5. 2024 expected to be more of the same. So it doesn't look too bad in terms of their balance sheet and in terms of that dividend safety. So let's take a look at the valuation for UGI, and we can see in today's episode, the intrinsic value is coming out to $36. Now, current price at $22. We do start off with 10% margin of safety, but we can see this is looking like a much higher margin of safety. Not quite at 40% just yet, but you are getting at least a 35% margin of safety based on our estimates, up to $23.62. In terms of Wall Street, well, they have a price target of $30, so they see some very strong upside at 34%. So they do believe that UGI Corporation is a buy. Moving on to the next company, we have Dominion Energy, another one with a nice starting yield of 5.9%. It is trading towards the lower end of the 52-week range with a forward P of 18. Over the last year, again, absolutely hammered, down 27%. And over the last 10 years, fairly similar, down 31%, although we can see a few times where it has hit their all-time highs of around $90. So let's take a look. The dividend does look to be safe with a score of 70. Market cap, 38 billion, a large cap company. Now, when we take a look at those recessionary metrics, well, they increased the dividend, pretty much had average growth, but also similar to UGI, they did outperform the S&P. And we can see here they have had a dividend cut and not increased their dividend since 2021, something just to be aware of, and therefore they've only had 1 year of consecutive dividend increases. In terms of dividend yield theory, well, again, we have that double sign of undervaluation, 5.89 yield versus 4.48 average, and we can see here the forward PE sitting below that 5-year average. And the utility sector P is pretty much in line with Dominion's 15.7. So again, for utility companies, we focus on the earnings payout. Below 75%, there have been some years where it has gone above, but in the more recent period, it is around 65%. 2023, though, it is expected to go up to 80%, something just to keep an eye on for that dividend safety. Earnings per share, again, a very similar story in the utilities industry. Whilst it does grow over the longer period, it is fairly inconsistent, and 2023, we are expecting a drop to the prior year. When we look at sales growth, again, it should come as no absolute surprise given the cyclicality of the industry. And we can see, though, overall in the longer term, it has gone up from 13 billion in 2013 to 18 billion in 2023 expected. Shares outstanding, again, very similar story for the majority of utility companies. They are essentially diluting your position over the longer term, but it is a common theme. ROIC then, above 7.5% is what we look for utilities. Other companies, it is 10%. 2023, it is coming back up to 7% as we did see a period where it dropped to around 5% lows. In terms of the operating margin, in better news, it is above that 18% minimum, 30% looking very strong for 2023. Net debt to EBITDA then, 5.38 expected in 2023. It is below the 5.5 and 2024 expected to be fairly similar. Something just to keep an eye on so it doesn't go too far up like we saw in 2016. So getting to the valuation of Dominion Energy, and in today's episode of the intrinsic value is coming to a fairly nice $48, but we can see the current price isn't actually too far off. So if we start off with a 5% margin of safety, we can see we only really see it trading at that 5% margin of safety. Typically, for pretty much every company, I would like to start off at a 10% margin of safety before even considering. What do Wall Street say? Well, they actually believe the share price will go much higher than our intrinsic value at $50.33 with upside of 11%. As always, do let me know your thoughts in the comments below whether or not you two have been adding any of these stocks. And if you enjoyed today's episode, smash the like button, hit that subscribe and bell button so you are continually notified of these videos. And don't forget to click on the pinned comment below so you can join the free weekly newsletter. We have just dropped our first edition today. It is one that you do not want to miss. And don't forget, if you're interested in running your own companies through the intrinsic value calculator to get to the acceptable buy of companies in your own portfolio and watch list, click on that pinned comment. Have a great day and catch you all on the next episode. Take care for now.